Hi. Welcome to this finance course for intermediates. In this course, we'll cover the understanding financial statements. For more financial dedicated videos, don't forget to subscribe and leave a comment in the comment section below. Understanding financial statements. A financial statement is a record of a company's financial activities. There are three main financial statements that you need to be familiar with: the balance sheet, the profit and loss statement, and the cash flow statement. The balance sheet is the first of the three main financial statements that companies use to give an overview of their financial position. It provides a snapshot of the company's financial position at a specific point in time. The balance sheet is divided into two main sections: assets and liabilities. Assets are resources that a company owns and that have economic value, such as cash, investments, real estate, and inventory. Assets are listed in order of their liquidity, which means that the most easily convertible assets are listed first. Liabilities are obligations that a company owes to others, such as loans, accounts payable, and taxes owed. Liabilities are listed in order of their due date, with the most imminent obligations listed first. Equity is the residual interest in the assets of the company after deducting liabilities. It represents the value of the company that is owned by its shareholders. There are different types of equity, such as common stock, preferred stock, and retained earnings. The balance sheet must balance, meaning that the sum of assets must equal the sum of liabilities and equity. This is the underlying principle of the balance sheet, that a company's assets must be financed either by borrowing money, liabilities, or by using funds provided by its owners, equity. In summary, the balance sheet is a useful tool for understanding a company's financial position by showing its assets, liabilities, and equity at a specific moment in time. The profit and loss statement, also known as the income statement, is the second of the three main financial statements used by companies to report their financial performance. The income statement shows a company's revenue, expenses, and profit over a certain period of time, usually a month or a quarter. The income statement starts with the company's total revenue, which is the money earned from its operations. This is followed by the company's expenses, which are the costs incurred in generating the revenue. Expenses include cost of goods sold, operating expenses, and other expenses. The difference between revenue and expenses is the company's net income, also known as profit. If expenses are higher than revenue, the company has a net loss. The net income or loss is an important indicator of a company's financial performance, and it is used to calculate key financial ratios, such as the return on investment, ROI, and earnings per share, EPS. The income statement also provides information about the company's operating performance, such as its gross margin, revenue minus cost of goods sold divided by revenue, operating margin, revenue minus operating expenses divided by revenue, and net margin, net income divided by revenue. In summary, the income statement provides a summary of a company's financial performance over a certain period of time by showing its revenue, expenses, and profit. It is a useful tool for understanding a company's operating performance, its ability to generate revenue and profits, and its financial health. The cash flow statement is the third of the three main financial statements used by companies to report their financial performance. The cash flow statement shows the inflow and outflow of cash within a company over a specific period of time, usually a month or a quarter. The cash flow statement has three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from operating activities reflects the cash generated from a company's normal business operations, such as the sale of goods and services. It includes the cash received from customers and the cash paid to suppliers and employees. Cash flow from investing activities reflects the cash generated from a company's investments in long-term assets, such as property, plant, and equipment. It includes the cash received from the sale of investments and the cash paid to acquire new investments. Cash flow from financing activities reflects the cash generated from a company's financing activities, such as the issuance of debt or equity. It includes the cash received from issuing debt or equity and the cash paid to repay debt or pay dividends to shareholders. The cash flow statement is a useful tool for understanding a company's ability to generate cash and its overall financial health. A positive cash flow from operating activities indicates that a company is generating enough cash from its operations to fund its growth and meet its financial obligations. A negative cash flow from operating activities may indicate that a company is struggling to generate enough cash from its operations and may need to find alternative sources of financing. In summary, the cash flow statement provides a summary of a company's cash inflows and outflows over a specific period of time, and is a useful tool for understanding a company's ability to generate cash and its overall financial health. Financial statements are an essential tool for understanding a company's financial performance and health. They provide information about a company's revenue, expenses, assets, liabilities, and equity, and help to paint a picture of its financial position at a specific moment in time. I hope you liked this video and don't forget to subscribe for more.